What is up, guys? Welcome back to another trading video. This is Trade Hour, and I hope you guys are all doing good in your trading at this current time. Today what I want to talk about is liquidity and what that means for us as traders, because at the minute a lot of people, including myself, get caught out on liquidity and knowing when to either short the stock or buy. So that's what I want to talk about today. As you can see the chart here today, currently on the Nasdaq, this is London times. It can work for New York times, it's the exact same thing. We see a lot of liquidity grabs, right? And what these are movements for the price to be pushed up with a new support and resistance level, and essentially for the market makers, which when I say market makers, I mean the banks, to sell off so that they can sell their shares for a profit. A lot of people, including myself, and I mean this, don't know when to buy into these. No one knows, right? But what I want to show you guys today is how to identify and use these to better use, right? Because we all want to be able to get in at the right time and take a load of points and pips and all that jazz, right? So that's what I want to talk about today. Alright, so as you can see currently on the Nasdaq, we have a lot of price action which is volatile. And what that means for us is that we want to target our entries to optimize the most profits, right? So how do we do that? So first of all, what we do is we look for moves which have a high volatility rate and there's not much pullbacks, and there's essentially there's not much support there, right? So as we can see with my cursor, we've got this here. We've then got this bit here, technically this bit as well, and then we have this bit here, which then leads to the downward spiral. We have this bit here that leads to the downward spiral, and we have this bit here. So what constitutes us to get in, right? At the minute there is nothing. However, there is this one small detail. So with anything with liquidity grabs, and what this means is the price going up immediately or down, and what they're trying to do is they're trying to target the orders, right? And stop people out, get the liquidity so they can push it up higher and then eventually sell it off, right? So what do we see with this type of movement? Okay. So when we first initially went up into this big blossom, this one isn't a good example because you'd expect this just to retrace and reverse back down, right? So out of reach, right? So from this bit, this has created our first level of support, right? Because what we've done is we've come down to this line, which is 167. And then from there everything has moved off of this range. Okay, so this right now is our current range for liquidity. Okay, try and do this for us just like that. So this is our current range for liquidity. So the first time that we make a big move up or to the downside and we have the first bit of support, that is our current range for today's session in today's time zone for exchanges. Okay, if you understand that, I'll try to make that as simple as possible. So this is what we now go off for our liquidity grabs, right? So as you can see this now, what's going to happen is I'm going to draw a Fib retracement to, let's just say, our nearest high, which would have been that. Okay, so if you saw my previous video about essentially what's a premium price and what's a discount to us. So like I said, so the range currently for us is this first bit of action of support, right? And then it spiraled, and this was our base for everything that's happened today. So our first point of retracement or reversal is our base for today's antics, right? So what I'm trying to say is, if you watch my previous video, you'll know that 62% position on the Fibonacci retracement is a optimized trading entry, right? So anything below this 78 currently is at an extreme discount to the market. So 62% is our optimized trading entry, so anything below it. So what I would suggest that we do is we take roughly round about here today on our entries, maybe a little bit higher, but you get the gist. So if you see this candle, this was right on our optimized trading entry, okay? So just like that, that one was right there. Ignore this little thing. I was just curious about the trend line and the breakout, and just to see what would happen with that. That's something in the works. I'm just trying to get a strategy for that. Anyway, so if you see here, so what happens is we go below the 62% optimized trading entry. So what I'll do, I'll just get rid of this. Okay, so I'm just going to try and make it really easy on us. So this is strictly, I mean strictly only for liquidity, all right? And getting in at the right time in a fast moving market, okay? Ooh. So this is our optimized trading entry right now. Is this current line. So we're under the 62% line, which is... So 50% is equilibrium, which is like, you know, kind of like fair value. 62% is our optimized trading entry. And anything below the 62% mark is an extreme discount to us. So what I mean by an extreme discount to us is that the market makers, who are the banks, like this level because this is a fair value to them. In terms of today's price range, right? This is fair value to the people that have a lot of money controlling the bank's jurisdictions, right? So what we want to do is we want to get out of the cycle of trading with the day traders. We want to be trading with the banks, right? Because we want to be catching these moves as they are, okay? So optimized trading entry, anything below this line is at a steep discount, right? So you guys need to watch my video on fair price versus premium price, right? And that will give you a lot of details in how to use Fibonacci and all that stuff, right? So what's this? This is let's just do discount to market. So so this line is currently a discount to market. So anything below the OTE is our optimized trading entry. Usually what I like to do is go a little bit below it, because obviously I want to take more profits. I'm a bit greedier. And anything below this line to this line is at a very steep discount to the market, and where most traders would like to go in, right? But having said that, what happens if we always go for the discount to the market? We might never hit within our range this to execute our orders, right? So how this transfers to liquidity grabs is quite simple. So you take, like this Fibonacci, this low to this high in this current range, what happens? So the first one we ignore, right? However, when we come back down from this little bit here, we are currently obviously going to be targeting this order entry, right? And what happens? We go from down here. So if you would have done discount to the market, you would have got in at a really great price, right? If you would have gone into our optimized trading entry, you would have got into a great price. And what happens? We rally to the upside, and we've just collected 50 points just like that, okay? So what happens when we go back up to the top and we've made a new form high for the day? Well, we're going to expect this to go down, right? Because if you watch my previous video, this now to the market makers is a steep premium price that they don't want to buy into. So what happens? we then go back down, and what do? We go back down to our optimized trade entry and our discount to the market. And what happens? We reverse back up to the top. So what I'm trying to share the light on to you guys is the fact that, don't get me wrong, there's going to be a bit of slippage, there's going to be a bit of volatile, and you may be down 10 to 15 points before you see any move to the upside. However, during this Fibonacci range, true range to us currently at this moment in time, we are collecting points, pips for fun. Okay, so this is how you trade big swings in volatility and liquidity grabs. All right. So another thing that I want to talk about is, you see these big sticks that go up and down, and it's just straight up, straight down. So when you have a big stick like this massive green one, when you have a big stick like this, it can go high, don't get me wrong, but currently trading in our range, this is a premium. So they don't want to trade past this really. They want to be selling off. But when you get big sticks like this, what happens is there's a lot of slippage, and it happens really quickly. Why? Because there's no level of support here. So we can just go back down to this range like nothing's happened, because it was just a liquidity grab. There's nothing really stopping us from going below that, because there's no orders being placed. Why? Because this was just to form a new high. And soon as we break below a certain point, this is just going to slip to the downward side. Anyway, so if we take this current range, right, and we take this current range to there, to here, right? So we know 62% is our optimized trade entry, right? And anything below the 78% range is a discount to the market. So let's just say at the current time we put our Fibonacci on this low after this. What we know is that our optimized trade entry is the 62% range. Anything below that is discount. And what happens? We hit this optimized trade entry, right? We hit this several times in order for us to get a better and more overall profit and a better view of the market. Okay, so it's quite simple, guys. So pretty much after our first move of the day, because usually we get a move of the day, right? Sometimes it consolidates and it's a really weird day. However, we either go to the upside really fast or we go to the downside. So after your first bit of retracement, which creates our first support level of the day, and which all our range bounces from there. So remember that. So our first move, and then our first bit of retracement, and which stays below that certain price. So what I mean by that is it stays from here, and then we go up, and this currently is what our range is going to be from. So like I said, you draw that Fibonacci, and then with these big liquidity grabs and volatility and big burst of candles, we can then target them with the Fib retracement. Okay, so I hope that sheds a bit of light onto how to trade these swings, because let's be honest, we all think it's going to go lower than it is. We all think it's going to go higher than it is. But what it is it's trusting your Fibonacci retracement. Okay. But one thing I would say is that the fibs aren't there to be used just on their own. You also need to understand the fact that that this potentially couldn't work, and that you could lose a little bit of money. So as you can see, this line for our previous low of the day and our first support, that's where I would be targeting my stop losses. What this gives me is a very clear indication that, okay, well, I could go below this line, but because this was our first support level, I don't think we will until we get to the New York Times, right? But remember, this works on all exchanges depending on the first opening bell, right? So if we go to the upside and we have a bit of retracement, that's our first support level for the day, and so forth and so on. So yeah, this would be our stop loss, and then our take profit would be at the premium value to the market makers, because we know we're going to get back up there because they want to sell it back down, right? Okay guys, well that's been today's video. I hope you've understood it, but like I said, go watch my previous video to understand the premium value versus the discounted value, and then that will help you with these liquidity and volatility, to help you trade it better and get better order entries. Okay guys, well that's been Trade Hour, and I thank you. Bye.